Hi, everyone. It's an honor for us to welcome Jay Pelosky again from TPW Advisory. I think this is already, the seventh time we do our bi-weekly call. It's a time I always look forward to. So, yeah, Jay, so great to have you again. And it's been a great, last week. We saw, all-time highs, in a lot of the markets. We saw, great economic news and from the IMF upgrading, world economic growth, and then, PMIs above expectations. So, can I ask you to do a wrap up of last week, and then we kind of, take it from there?
Sure, Roberto, and hello, everyone. Good afternoon. Great to be with you again. It's amazing, Roberto, that we're already talking about the seventh one of these. I mean, that's crazy. Time is just absolutely flying by, right? COVID speed actually happening as we speak. And so I went back. It's funny. So while we're moving fast and forward, I went back in time and you get something in your head every once in a while, like a song or a lyric or a comment. And last week I had in my head, "The song remains the same." And I don't know how many people remember that, but it was a famous Led Zeppelin tune way back in the day. I'm sure you're too young to remember, and I'm arguably too young to remember when it came out, but it was very popular and kind of classic rock. So "The Song Remains the Same" was actually the title of the Musings, and basically suggesting that, as we end Q1 and we look into Q2, I expect the song or the markets to kind of remain the same. And I think the markets have done an admirable job of pricking all the different bubbles that have popped up over the last 6 months. Think about the FANG stocks. Think about the work from home craze. That peaked back in September vis-a-vis the broader market. Think about the GameStop and the Robinhood bros and the retail investor takeover. That stuff's down like 60 or 70% volume levels of retail trading in the US, down 60 or 70% in the last 2 months. Think of the Clean Energy and the ARC names and all that stuff, and Bitcoin. All of them have had 30% pullbacks year to date. And we kind of capped it off with the Archegos affair, right? This forced liquidation of huge, massive tech positions. So to me, that's great because it suggests all that kind of stuff has been taken out of the market. And so now we're much more stable, and I think we can look at the fundamentals. And so now you mentioned a couple of them, data pretty good, clearly economy's recovering, vaccinations improving. In the US, we're up to over 4 million shots a day on most days. We're getting ready to, or we will be at 60% of the adult population vaccinated by the end of next month, by the end of May, which should give us herd immunity, given the sense that there's somewhere around 20% or so that have already had COVID. So that is clearly moving forward. And then we're also kind of coming into the whole earnings picture, right? Earnings begin this week in the US with the banks. They should be extremely good numbers. So while lots is going on, I think we have pricked a lot of bubbles. We've set up, we've removed all the froth and all the hype. And now I think we're ready to kind of see how we do with the testing of inflation concerns, which again, we got a taste of last week with 4% PPI numbers in the US and in China. So that's going to be probably the focus here in the near term. Watch how the bond market does, how earnings come through. And if other areas like Europe and like parts of Latin America, Brazil, etc., can get a better handle on the vaccination process.
No, that's great. It's a great way to start. So in the musings, you talk about the testing times, and I'd like to comment on these three tests we're going to have, so to speak. So the first one is inflation, and although you have been speaking, about it for at least 6 months, the Fed has told us, to be cool. but you never know how it's going to happen. So talk about the inflation prints that we're going to have. That's the first one. The second test, seems to be earnings, and from what we've seen, earnings upgrade, continue to go up. And the third thing is which finally seems to be happening is the Europe accelerating the vaccination pace. So, but when you talk about that, please remind the audience of the divergences you talked about last time. So the ones within Europe and between Europe and the US.
Sure, Roberto, and I think that's absolutely right. And one of the things that I like to do is I like to let the market tell me what's happening rather than me try to tell the market. And over the last couple of weeks, we've had some situations where the market is speaking loudly, particularly in fixed income. And I'll just reference two. The first is the announcement of the America Jobs Plan, right? $2.5 trillion package that announced by President Biden. And then secondly was the March job numbers, which at 900,000 plus new jobs was a full third higher than the consensus.
And you called it right. You talked about 1 million jobs, 2 weeks ago.
Yes, exactly. So kind of in the right direction. But what's interesting is how the bond market reacted, because I think this gives us a sense of what we might see happening with these inflation numbers. So the bond market with a $2.5 trillion jobs plan after a $2 trillion rescue plan and a much bigger than expected jobs gain, what did the bond market do? It rallied, right? Interest rates fell. And so that tells me that an awful lot of the concern and the kind of offsides nature of the fixed income community has been redressed. And now it's consensus that we're going to end the year around 2% on the 10-year, somewhere between 2.5% and 3% on the 30-year. And so the element of surprise, which is when you get the sharp moves. And look, we had an 80 basis point backup in bonds, the U.S. Treasuries on the 10-year in the first quarter, 30 basis point backup in March, and yet stocks were up for the quarter, up for the month. And I think that tells you market equities are fine when rates are going up because the economy is recovering. It's perfectly fine. And so I expect, again, that to continue. So now we're in that testing period where we're going to see headline numbers much higher than we've seen in the last year or two. But it's mechanical. It's simply because the negative CPI numbers in the United States last March, April, and May, because of COVID, those are falling out of the year-over-year comp. So it's very mechanical. And I think we should look through it. I think it's going to be transitory. The core CPI or the core PCE indicator, which is what the Fed looks at, much stickier, doesn't have the same volatility. And so unlikely to have the big jump up that we're going to see in the headline CPI, probably starting as early as I think this week, we're going to get the March CPI number for the U.S. And it's probably going to be like somewhere around a 3% handle. It'll be very interesting to watch how the 10-year does, because we also have, again, the supply issue. I think it's some astronomical number of 250 billion or so of Treasury issuance coming up. And so that obviously is going to require buyers. And I think the good news there is that the foreign buyer is likely to see these yields, even at 1.65 or 6.6, whatever we are, as pretty attractive. And we've talked about this a couple of weeks ago. Hedged yields back into euros and yen are as appealing as they've been in the last 5 years. And the Japanese, who are big players here, they weren't participating in February and March. In fact, now, post fact, the data's come out that said that the Japanese sold $6 billion worth of treasuries in the month of February. Now their fiscal year is over. Fiscal year ends in March. New year starting, I would expect them to come back and be buyers. So we'll see how the inflation works. But you and I wrote our piece, higher rates are a good thing, for the Brazil Journal, I think almost exactly 2 months ago.
Yeah.
And we said to not worry about inflation. and that was going to be the secret to investing success. And I have to say, Roberto, I think you deserve a lot of credit because that's been 100% right. So kudos to you, and I'll take a little bit of credit. But together, I think we were pretty much spot on with that.
No, fantastic. Yeah, and that's on inflation. And the second one is the earnings season. I mean, do you have any particular, insights? And of course, we start with the banks, and given what happened to rates, should be a pretty good quarter for the banks. But let me know if you have more insights.
Yes, no, I think it's good to kind of break it up a little bit, and you and I can chat a bit rather than me just kind of run through the whole thing. But yes, the earnings picture is next. It's going to be good. The change in Q1 earnings during the quarter was as high as it's been in the last decade. Even in Europe, where all the news has been so negative, at least the headline news, so negative about vaccination mess and lockdowns, earnings for the year have gone up 3% higher than they were back in December for Europe. So that's kind of interesting as well. And an important point, I think, for investors to remember, the PPI number is actually not bearish for companies. It's actually quite constructive. Yeah. And JP Morgan had a piece out over the weekend making the point that the relationship between rising PPI and rising earnings is clearly positive for earnings. And so I think that's something to keep in mind. And so I think what we're going to see in the earnings picture is good numbers. There's no doubt, right? We're comparing to last Q1. I think the expectations are 25% year over year for the US, maybe even higher for Europe, 28%. I think Japan is in there somewhere in the 20s. So they're going to be good numbers without a doubt. And it's going to be a question, I think, of where companies see the next move. And where investors are going to take confidence from those numbers and kind of project higher numbers for certain sectors. I think particularly on the cyclical side, and particularly kind of outside of the U.S. I think it's probably where Europe, which is right now maybe a little bit overbought. I made the point in the Musings. I think Europe is up 5 or 6 weeks in a row. It's only been down 3 weeks since December. So, secretly, quietly, under all the negative headlines, Europe has been a great place to be as an investor. And I think that's going to continue after we work off a little bit of the overbought condition. So I'm expecting good earnings. It's going to be interesting to see how the market does. Remember, the other thing about this time in terms of stocks in particular is that seasonality is very positive. April and May are among the two best 2-month periods for the S&P historically. So we're in a favorable period for stocks. We're going to have very strong earnings. I think most of the unease about inflation and interest rates have kind of been dealt with. And so to me, it's pretty favorable risk reward as I look forward here into the second quarter.
That's fantastic. And one thing I remember, we talked about the divergence last time. So and within Europe, between manufacturing and services, and as you mentioned, despite all the negative news, we had today, retail sales in the Eurozone, better than the market was expecting. There was 3% month over month. Market was expecting, 1.7. Last week, the PMIs were better across the board, than the first reading. And even in services, of course, manufacturing would expect because of, that they're all selling to China, but even in manufacturing. So, but what's causing most of the divergence you talked about is the vaccination. And it does seem to me that they are really accelerating the pace and correcting the mistakes they made in the first quarter with all the AstraZeneca, spat, with the UK. You have the same perception?
Yeah, I think that's exactly right, Roberto. And certainly you pointed out the retail sales almost double what the consensus was. The manufacturing PMI is over 60. And JP Morgan, again, came out with some work saying that historically PMIs over 60 equate to earnings in the high 20s to low 30s year-over-year earnings growth for Europe. And the last point I'd make was that not just the manufacturing, but the composite for Europe is over 50. You would never think that if you just looked at the headlines, right? March composite PMI was 53 for Europe. So if you just looked at the headlines, you'd think it was probably 23. But reality is 53. So for me, the divergences that I've been talking about were really threefold. First was just the market divergence, right? Making the case that investors should overweight Europe, overweight Japan, overweight the non-US markets as we came into 2021. And that divergence in terms of performance, in terms of valuation, AQR, for example, Cliff Arness, who's very, very well known in the US, made the point that the divergence in valuation between the US and EFA, so not just Europe, but including Japan and Australia and a few others, is still extremely wide. So we've really not done much at all to kind of change that relative performance on anything other than like a 1 year point of view. So that's first divergence, right? We want to take advantage of that divergence and overweight the non-US equity markets as part of the rotation, the golden age of asset allocation that I wrote about back in November. And that part's working out fine. Europe is outperforming, ACWI ex-US outperforming, so that's good. The second divergence is the vaccination divergence. And obviously here it's just super wide, right? US, as I mentioned, 4 million shots a day. Europe can't seem to get out of its own way. But that's changing. And you picked up on it with your comments, Roberto. But my understanding is that France got to its 10 million vaccination target a week early, that Germany is now doubling.
Yeah, Germany's doubling.
Higher rate of vaccinations. And they still hold to the expectation of reaching herd immunity by late summer. And this has been the timeline from Europe's point of view since the last couple of months. So slow start, absolutely. But I think there's a fair degree of confidence that they're going to be able to get to a point of still meeting their vaccination targets. And this is where I think the public health system in Europe, which gets a lot more money and is more well-funded and better, more robust than the US public health system, should really start to kick in, right? Because it's been a lack of vaccines that has been the problem. So you get the vaccines, then you can move forward and leverage that public health system in Europe. And I expect that to be the case. So that divergence between the US and Europe in vaccinations, I think we're at the wides, we're starting to shrink that. And then the last is obviously the economy. Again, US is going to grow probably 4% year over year in Q1. Europe may well have negative growth in Q1. So I think we're at the wides there as well. As we go forward, that divergence should narrow as European growth picks up and the vaccinations take effect. Lockdowns become easier, as we're seeing in the UK. We're going to get to see, again, I've been a big believer since the very beginning of COVID. Follow the leader, first in, first out. So you were able to see what was going on in Asia and apply it back into the US and Europe. We're now able to see what's going on in the UK these next couple of weeks and months and figure out what's likely to come next in the US and then after in core Europe. And the footfall traffic, I read some amazing statistic this morning, like over the weekend or something, up 300% year over year. So, I mean, we're going to see some dramatic numbers. And the interesting thing is, to me, what does this mean for the currency? For the euro, for the dollar, and for EMFX? And my thinking is that the dollar has had its chance to kind of take advantage of this much better than rest of the neighborhood kind of performance, and break out. And it did not do it. And so, and the euro had the chance to break down, did not do it. So again, let the market tell us what's going on. And so for me, I think there's a decent shot that the dollar rolls over here and people stop focusing on the kind of exceptionalism of the U.S. Virus response or vaccination response and growth response, and start to focus on the twin deficits of huge current account deficit because we're importing all this stuff, and huge fiscal deficit, which even with the plan to kind of account for most of the jobs plan via tax hikes, we're still going to have a fiscal deficit double digits in the United States this year. And so my expectation is, where's the opportunity that comes out of that? And I'm kind of intrigued by local currency emerging market debt, which is a place that not many people like these days. But to me, I think you could have a turn. You're seeing it a little bit. The lira, Turkish lira, didn't blow out with all the shenanigans there with their central bank. Brazil, the real, with Lula news, etc., had an easy shot to go break 6, did not do it. Mexico, the Mexican peso, breaking around 20, perhaps going under 20. So I think it's actually kind of interesting to think about narrowing divergences between the U.S. and Europe, euro up, dollar down, and potential for EMFX to be a little bit of an upside opportunity.
Yeah, no, you mentioned some very interesting points, and I've also been highlighting. I mean, of course, borrowing from what you're saying, on this divergence thing. But if you look at the DXY and also the euro dollar, which of course, two sides of the same coin, they failed to break out, so they're now within the 200-day moving average. So as you said, it looks like the U.S. dollar is going to roll over. And I think it's very safe to bet on this. I mean, some people are betting that the euro will appreciate now that Europe is speeding up vaccination. But the other thing, which is actually very shocking, not shocking, but it's a big number. You talked about the trade deficits, $70 billion trade deficit in the U.S. And something I remember always, it's one of the sayings of markets is that every time the U.S. deficit is shrinking, somebody blows up. Some emerging market blows up. But now the opposite's happening, and emerging markets are not benefiting. And I try to look for the answer, and it has to do with the other point we have to talk about, and this is China. So some people are saying that maybe the reason why emerging markets are not doing that well is because there is the fear of
Hello, Roberto. Hello, I'm not sure what happened there. Maybe Roberto went offline, but I can talk about China in the interim until he gets back. How about that? So I'm not really as concerned as some seem to be about China. I mean, I think first of all, it's had a very healthy correction. It led the way, again, as I mentioned a few minutes ago, first in, first out. Asia was first into COVID, first out. The Asian markets, not only China, but Taiwan, Korea, really dominated in Q4, outperformed pretty much everybody. And so it's perfectly natural that now it's at a pullback and come back in. And that pullback's been exacerbated by not only worries about maybe the government pulling back on the credit lever, but also the concerns about Alibaba, Ant Financial's IPO being pulled, etc. And I made the comment today to some people that China is tougher on its big tech than the U.S. is on our own big tech, which is pretty funny, right? Because you wouldn't necessarily think.
Yeah, and I agree with you on that. And people have asked me, about this in the past. I think, what the Ant Group was trying to do was regulatory arbitrage. Mm-hmm. Because you cannot be a bank, act like a bank, do everything that a bank does, and do not want to be regulated as a bank. So I guess that's what China is doing.
Well, yes, and they're cracking down on the power of the platforms there, because those platforms are much more powerful within the China ecosystem, economy system, than even the ones are here in the United States. And so it is interesting, though, that those are being brought under kind of control, which is probably good systemically. But in the near term, these are the leaders of the markets in China, and so the market is pulled back. But now you have a situation where some of the China tech stuff is oversold. The Chinese markets have pulled back significantly. I think it's been a 15% correction. You now have a situation where technically they look a lot better. And so to me, it's and the credit concerns, I think, are overstated. I tweeted out, and folks should follow me on Twitter. I know Roberto and I go back and forth a fair bit. You're wonderful on Twitter, Roberto, and that's great. But I tweeted out that even with the guidance of the regulators in the Chinese banking system, they're still targeting 11% year-over-year loan growth. So it's not as if they're saying, oh, we have to shrink the system. They're saying we don't. It was at like 15 to 20%, I guess, here in the beginning of the year, and so they're reining that back. But look, I mean, one simple thing to keep in mind is that this is the 100th anniversary of the Chinese party, and I highly doubt that they're going to allow anything to happen to mar that celebration. And so to me, I think Chinese concerns are overdone, and I'm spending more time looking at it as a potential area to add than to do anything else.
No, that's great. And talking about that, I mean, where do you add and where do you decrease? You talked a lot about your portfolio construction on the Musings. So why don't we talk about this now? I mean, talk about your portfolio construction approach. And there are also some great comments about the divergence in the portfolio and where do you see opportunity?
Sure, and thank you for that opportunity, because the model portfolio delivery service is something that I offer at TPW Advisory, and it's relatively new. It's only been available since the turn of the year, and I am quite excited about it. I think the environment currently really plays into my strengths as a global multi-asset guy. I think the thematic approach that I've been writing a lot about, investing thematically in the tripolar world, was the title of my March monthly. So it's definitely top of mind. And I think the linkage between global macro thinking and thematic investing is very, very tight, right? Thematic is kind of works off of macroeconomics, works off of politics and policy, all the building blocks that are in my global risk nexus and embedded into both my approach and the thematic space. So the model portfolio process basically for me is looking on a monthly basis, if not more. Well, obviously I look at it daily, but in terms of providing the model to clients, we offer that on a monthly basis. And so over the last week or so, I've been updating the model. And it was very interesting to look at a couple of different points. First was that I wanted to look at not just the year-to-date performance, but going back into last year. And so to avoid the comparison of March of 2020, right, everything's going to be up 80%. That's meaningless. I went back to the end of 2019. And lo and behold, half the positions in the portfolio are up less than 10% or are down since the end of 2019, so 15 months. And that compares to ACWI, the global equity index, up 20% since the end of 2019. So that to me suggests that there's lots of upside in the portfolio, and I like that. And so, and it's really no surprise, where do the bulk of those positions live? Where do they represent? They represent Europe, right? The European ETFs are still flat to down versus the end of 2019. So lots of opportunity still there. The energy space is still down significantly versus the end of 2019. So opportunities there. Japan is up just a little bit, etc. So lots of opportunities in some of the U.S. value stuff, while having big moves in Q1, are still down from where they were at the end of 2019. So that was really, that was insightful, and I didn't really expect that, to be honest, that many, literally half the positions. And the portfolio, by the way, is 20 to 25 or so ETFs to represent a global multi-asset thematic ETF opportunity set. So on the thematic side, we're now expressing 9 separate themes in the portfolio, and those themes added up equal to about 23% of the model. And those themes range from crypto to clean energy to cyber to fintech to batteries to electric vehicles to ARC innovation. So a very nice, widely dispersed spread of thematics, which I am now thinking about in the context of the potential for a surprise U.S. Treasury rally, right? So instead of rates going up when we run into the inflation test we started the conversation with, what if rates rally and that rally kicks off a NASDAQ-led melt up in stocks? How would the thematic portion of the portfolio perform in that environment? Would it give us a little bit of a edge? Because I have very little big cap tech in the model, right? As you know, I've had the view for months and months and months that rising rates and vaccinations equal kryptonite for big tech. And that's been exactly the right call. But we can have a counter trend rally, and I don't necessarily want to be left behind for that. So we did the analysis, and lo and behold, the broad thematic, that slice, 23% or so, has a correlation with the NASDAQ of 0.68. So we're going to get some participation, which makes me feel a little bit better, so that we have the thematic and the value tilt, right? Not only geographic value, so not only Europe and Japan, but also sectorally, U.S. energy, U.S. financials, IUSV, the broad U.S. value ETF, etc. And so the last point I'd make, Roberto, about the model was that we have a high-class problem of liking pretty much all the positions in the portfolio, but wanting to kind of get a few more in there. And it was a real job to find the opportunity. And many of your clients and folks listening know this well from their own experience, trying to shoehorn a couple of additional names in there. It was quite a task, but we were able to do it. And so quite happy with how the portfolio looks. It's got some carbon in there, which I think is going to be interesting to watch here as we go forward. So all in all, lots of upside given the number of positions that haven't really moved in 15 months. Leverage and protection against a surprise NASDAQ-led rally, and a high-class problem of liking everything in the portfolio. I went down item by item trying to see, okay, who can I kind of kick out for the better opportunity? And basically I punted and shaved a few things and basically got the money to add 2 new positions. But, I think that's a high-class problem. And if anybody's interested, feel free to reach out to me, shoot me an email. Be happy to talk about how we might use that service to help others.
No, that's fantastic. And just so people have that clear, so the reason for the NASDAQ-led rally would be the fact that, the surprise, in rates, inflation has not happened. So actually, let's say we do get, a 3.5% or even 4% inflation print. All of the Fed talk and the fact that this has already, that the markets have been already prepared for this. Is that what leads, to a rates rally?
Yeah, I mean, it's basically as simple as we had an 80 basis point backup in a quarter, right? Who's to say we can't have a 25 basis point rally?
Yeah.
And all of a sudden, foreign buyers come in because you have to remember the treasuries represent like 65 or 70% of the positive yielding government debt in the world today. So there's even now, there's still not a lot of liquid yielding safe assets. And so a lot, as I mentioned, I think people have gotten on sides. You know, you remember we talked about it at the turn of the year that the biggest single offsides call the sell side had going into 2021 was the forecast of the 10-year ending the year at 1.2%. That's now gone. Everybody's at 2% or north of 2% for the year end. So all I'm saying, kind of, Roberto, and it wasn't even me, I picked it up off a guy who is quite active, David Hunter. I gave him a hat tip in the piece. Someone to follow maybe on Twitter, interesting points of view. But he was the one, or at least that I saw, talking about a surprise counter trend rally that takes the 10-year underneath 150, and that because of the effect of higher rates on long duration growth stocks, the biggest beneficiaries would be the NASDAQ, which has now corrected fully, right? You've had a 15% pullback, so it's ripe for a move perhaps. And so I want to protect my portfolio, my model, which doesn't have much of U.S. tech exposure. It has the thematic exposure, but not the dominant tech exposure. We're in the innovative side of tech. Remember, I wrote that piece, the Musings, you know, down with innovation, up with innovation. So that's the idea. Counter trend surprise rally, rates drop as opposed to going higher. NASDAQ outperforms. And will that thematic slice of the portfolio, will it serve as a little bit of a hedge? Will it too go up, you know, somewhat in line with the NASDAQ? Because if that happens, the value side is not going to go up, right? So you need something to kind of balance. And I feel like the thematic does balance a little bit the value side of the portfolio.
No, of course, it's a great point because, you know, if, you know, given what, you know, the U.S. Treasury market represents of positive yielding securities, I mean, you know, the yields, you know, they cannot go up on a straight line because, you know, you have buyers, and as you said, from Japan to Europe, you know, from anywhere, because, you know, people, you know, despite all the positive, you know, in the Goldilocks scenario for equities, some pockets of the market, some people have to you know, to look for yield and you know, in bond markets. But no, of course, a great point. So talking about the themes, one, I mean, I'll not say it's my favorite one, but it's one of my favorites is the climate, you know, climate carbon. And as we were discussing before we went live, can you go over your expectations for the climate summit? And what kind of developments we can have on that sense? I mean, is there going to be a transatlantic, you know, carbon market? What is your expectation there?
Yeah, I think that's a great question because I do think something might be brewing. I have no inside, you know, scoop or anything, but one of the things that struck me was the absence of talk about carbon and reducing the carbon footprint when the jobs plan came out, which has a big climate component to it. But carbon was really not mentioned at all. So that was the first thing that kind of raised my antenna. The second was seeing that John Kerry, who is the climate czar for President Biden, is scheduled to be in China, I believe, this week. And so that made me think that perhaps there's a deal brewing to deal with carbon, perhaps being announced at the virtual, I guess, Earth Day Summit at the end of this month that President Biden is hosting. And so I know you're aware that Europe is very focused on what it calls its Carbon Border Adjustment Mechanism, CBAM. And the U.S. is saying, please don't put that into effect because U.S. companies are going to be hurt. But I think, what if there can be some sort of an arrangement between Europe, China, and the United States for a common, much as we're seeing discussion around common taxation of corporates, right? That conversation is moving ahead fast because every government needs revenue, right? Who's got the revenue? The corporates got the revenue. So who's going to pay? That's easy. Okay, so what else do we need to do? We need to bring down carbon emissions. How can we do that? Europe has said we're going to do it by setting up this border adjustment mechanism. They already have the emissions permit trading system. And so that is well set up in Europe. The rest of the world would rather not have that happen because what it would mean for their imports. But I do think, and here it's maybe more US specific, but one of the things that's clearly happening, Roberto, is that companies are being challenged to become more socially aware and visibly socially aware in the United States. They're being pushed by their shareholders, by their employees, and by their customers. And so the Georgia voting law, and I don't know how deep into the weeds we want to get for your clients, but
please.
I'm sorry?
No, please.
I suggest people pay attention here. So there was a law passed by the Republican House in Georgia to kind of limit voting rights of some kind or another, different aspects of how many days you can vote, how many votes you can have, and in terms of in person versus mail-in, etc. And there has been a lot of pressure brought to companies who are headquartered in Georgia, like Coke, like Home Depot, even Major League Baseball, which was going to have its All-Star game in Atlanta, was pressured to move the game. So these companies can no longer kind of sit and pretend that this stuff doesn't apply to them. It's a real sea change, and I expect it to happen elsewhere as we move forward. And my supposition is that the next issue that shareholders, employees, and customers push the companies on is going to be publicizing their carbon footprint. And when they are pushed to publicize their footprint, they're going to want to reduce the footprint. And the way they do that is by buying some of these offsets and these permits, which will drive the price up and which will benefit some of these carbon ETFs. And it's so interesting, just as I was writing my musings and writing about this, I noticed a quick headline came across that BlackRock had just released 2 new carbon, I forget whether it's carbon reduction or carbon adjustment ETFs to deal with something similar. There's one ETF that I particularly like, CRBN, I believe I've mentioned it before. It doesn't have any companies in it. It holds the emissions, the European emission permits and treasuries. And so it's not companies.
Is it C or KRBN? It's C, right?
K is in Kevin.
Okay.
K is Roberto, B is in Brian, N is in Nancy, KRBN. But anyway, I think that the two things, the need to kind of come to grips with the CBAM that Europe wants to put in place, the need to generate tax revenue by every government, thus the focus on global minimum tax. What's to say we're not going to have a global minimum carbon or maximum carbon footprint type of deal? And then, importantly, the growing pressure to have companies take a stand on social issues. First, voting stuff here in the United States, and I will not be surprised at all if increasingly companies are going to be required to publicize their carbon footprints. And as I said, I think that will drive significant interest in the offset and permit world to reduce those footprints. Because when that happens, when you have to publicize a lot of companies who people haven't really thought of as being, big polluters, are going to be seen as being big polluters.
Absolutely, yeah. And that's a big opportunity. Yeah, and that's a big opportunity for Brazil. I mean, some people say that Brazil could be the Saudi Arabia of the carbon offset market. So no, I think it's the best opportunity that Brazil has had in a long time. I forgot. We had to talk about taxation. But before we talk about this, I mean, it's amazing how the market has bought into your idea of the new ideology of the U.S. government. That it's breaking a 40-year tradition. So even the Financial Times is talking about what the new Washington consensus is. So I mean, it's
you get it here first, Roberto. Right? You know it.
Yeah, well, yeah, I heard it from you
about it
first.
for months.
But are you surprised that of course we all knew that all of this tax, all of this fiscal expansion would have to be paid. I mean, are you surprised by how lightly the markets have taken it so far? That they know that taxes are going to be risen. I mean, they're going to be raised. I mean, how do you see the market reaction? I mean, the stocks have not been down, I mean, does the market believe companies will get away with it, or?
I think it's the market response has been pretty appropriate in a sense that, first, nothing's really been decided.
Yeah.
We're going to discuss this. It's going to be discussed. I do think that the jobs plan is going to be passed, much as the rescue plan was, via reconciliation. That has now been judged to be within the rules. Importantly, I think President Biden will make an effort to try and generate some Republican support. And by the way, much as the rescue plan, the jobs plan is very popular across both sets, across both Republicans and Democrats, and definitely independents. Very popular. So the pressure to go against the jobs plan is going to be, I think, somewhat high for certain Republicans in certain areas. So a nod at least towards bipartisanship, and then if not feasible, via reconciliation. So I expect pretty much the same dollar amount and the same program setup approved in the next couple of months, just as the rescue plan was approved. And so on the taxation side, I would say that, I don't think it's as big a deal as people want to make it out to be. Yeah. In large part because effectively what the president is suggesting is reversing tax cuts of only a couple of years ago. Yeah. So it's not as if we're going to some never before seen level of taxation. We're not even going back to where it was 4 years ago, 5 years ago, 2016, right? The Trump plan was 2017. So we're talking about, a tax on the corporate side, much akin to what it was 5 years ago. I do think probably bigger is the global focus on a minimum taxation. Yeah. But as I said earlier, it's really pretty simple. Governments need revenue. Who has the revenue? Companies have the revenue. It's pretty straightforward to me. It's not a surprise, and I think that's kind of that's focusing on relatively. I mean, at least from a macro perspective, right? At least from a top-down, global, thematic, multi-asset perspective, not really all that important. On a company's sector analyst level, stock picking level, sure. I mean, probably have to pay reasonable attention to it. But to me, the big point is that we're going back to something we had 5 years ago. The market likes the idea that it's going to be paid for. And arguably, the president kind of threaded the needle between really worrying about, letting the fiscal deficit stuff just explode and really worrying people there, or being too aggressive on the tax side and having people really worry about that. I think, at least so far, it's a reasonably good job of threading the needle. And I think relative to everything else, all the other shifts we've talked about, the regime changes we've discussed, I don't think the taxation one is particularly high on the level of importance.
Oh, that's excellent. Fantastic. And I guess, of course, once again, you were right in the first one to see this, but are you to some extent surprised by how fast and how big, the government has gone on all of the issues we have talked about?
No, it was very clear to me that that this administration is staffed primarily with ex-Obama people, particularly on the domestic policy side. And they know that they went too small and too slow in the aftermath of the great financial crisis. And that led to the rise of the Tea Party, President Trump, economic nationalism, and political polarization, none of which is good for the country. And so I think the focus here is huge challenges: COVID, climate, inequality, historically cheap money, and the model of COVID speed of science, right? Global intellectual and financial capital focused on a single issue, leading to unprecedented response of multiple effective vaccines in 1/10 of the time. So there is a recognition, I think, in the Biden administration that things are moving fast, that they need to go fast, they need to go big. They have the capacity to do so with reconciliation, and they have the opportunity politically that if they're successful with COVID and successful with generating an economic boom, that 2022, which historically in the midterms goes to the party out of power, that the Democrats could change that dynamic and pick up seats, particularly in the Senate. I think the House is going to be where the real action is. The Republicans have to defend many more seats at the Senate level than the Democrats do. So I think there's an opportunity potentially to pick up seats for the Democrats. But in essence, the issue is go big, go fast. It's economically smart. It's politically smart. And it's what the country wants to see. The country is desperate for some sense that competent people are in charge. And I think that's being rewarded. And that's why you see, the 70% plus popularity of both the rescue plan and the jobs plan. People are very much in favor of it.
No, fantastic. And to wrap up, I follow your tweets, and over the last few days, we talked a lot about the tripolar world. But specifically, about things happening in Europe and in China that subscribe to your view. Can you talk about this? To kind of wrap up.
Sure. I continue to think that the tripolar world of regional deepening and regional integration in Asia, Europe, and the Americas is manifesting itself. I think the talk about digital coins, for example, in China is an example of this. I believe we're moving towards a world of regional currency blocks almost, not necessarily so formal as blocks, but clearly Europe has a euro. The bulk of the Americas trades off the dollar, right? We know this very well in Brazil and Argentina and Mexico, Chile, Peru, etc. And increasingly in Europe, the various currencies trade off the Chinese yuan. And so the idea of a digital coin, which is making a lot of noise around the world, is an example of moving this further into a more formal approach. And I think it just goes along with all the pressure on China, the sanctions with semiconductors. One of the reasons why the semiconductor market is in such disarray because of the US sanctions on Huawei and other companies. in China, which doesn't get a lot of coverage in the U.S., but it's hard to deny the reality of the linkage between the two. And so I do think that Europe has a great opportunity. I continue to think that Europe could win the decade of the 2020s. The decade of the 2010 to 2020 was clearly Asia and China. The preceding decade was the Washington Consensus. So a US-led decade, the unipolar moment. And I think there's a very reasonable chance to suggest that the 2020s could be the decade of Europe, where they integrate their Green Deal with the Joint Recovery Fund and really drive home the opportunity set that exists in Europe, which is 500 plus million people, $18 trillion economy with a huge valuation gap relative to the United States, as I mentioned earlier. I mean, the European banks still sell at 0.4 times book.
Yeah,
0.4 times book, and they're up almost 100%. And I mean, Morgan Stanley just in their weekend stuff was talking about UK banks having 50% upside in their bull case. So in the next 12 to 18 months, 50% upside in the bull case for UK banks. So to me, I think there's a lot of opportunity in Europe. And then we come to the Americas. And as we've discussed before, I've wondered what is the case for the Americas. But I think potentially now, I think there's a much greater understanding in the Biden administration of what's happening in Central America vis-a-vis migration. I think there's increasing business awareness of the linkages between North and South America, as we've seen with some railroad M&A activity of late. I think there's a real opportunity for Brazil, as you mentioned, to drive some of the climate action in their favor. So to me, the Americas still has got the least coherent case relative to Asia, which is clearly centering around the consumption that's going to drive that whole region. Asia is the region for consumption for the next decade. Europe has the opportunity to do what I just discussed. And then you think about the Americas. And here, a re-stimulated kind of big government drive to reestablish American opportunity is pretty much called for, in my view. And I think that's an example of how the tripolar world framework, which is the first piece of my analysis, allowed me to see the opportunity of that go big, go fast well before most people. And now it's in the press almost every day, but I was writing about it 3 months ago, 4 months ago, and talking about kind of the surprise, the twist in the tail for the investor is that it doesn't necessarily mean U.S. equities are the place to be. That's what's so funny, right? Because you have a huge gap between U.S. governance, the brand, which is down here, right? Subterranean after the last bunch of years, and U.S. financial asset valuations, which are off the charts. So as this one comes up, right, the political brand of the U.S. the financial asset brand is going to go down, which is, again, counterintuitive, but I think is exactly the way to think about it. And again, is something I think the tripolar world, the construct, which is proprietary to me, I developed it over the last decade, is the type of work that you get when you work with TPW Advisory and is insightful enough to help you shape your portfolio construction and hopefully generate some decent returns.
Oh, that's fantastic. So yeah, we're right off the mark. So I was going to ask something about geopolitics and risk, but we can leave that for the next time. So I mean, how if there's anything that keeps you awake at night, other than coffee. So at some other time, we talk about highway and Gulf Stream and Nord Stream and these sort of things. So what are the geopolitical risks? But things have been going pretty much in line with what you've been saying, and it's been great. So, I mean, again, for the folks that don't know it, please check out, the Led Zeppelin song. The song remains the same. And yeah, as you said again, let's keep calm and carry on. So it was great, having you. Look forward to the next one 2 weeks from now. And yeah, thanks again.
All right, Roberto, it's always a pleasure. Great to engage. The hour really flies by. I think we covered a ton of ground.
Yeah, of course.
So, hopefully your audience can really dig in a little bit. But was great as always. Super excited to see the development of Ohm Research, and happy to be a part of it. And look forward to, as you say, my musings will be out this Friday, but the next one of these video sessions will be 2 weeks. So I guess the 26th or so of April.
On the 27th, yeah.
27th, okay.
Yeah, the 26th, sorry, 26th.
26th. Well, we'll get that. We'll get that part ironed out. That's easy. All right, Roberto. Take care.
Okay, thanks again, Jay.
Thank you very much. Ciao.
Bye-bye.